Welcome to the Investors Podcast. I'm your host, Stig Brodersen, and today I'm accompanied by our investing mastermind group here for Q3 2021. So, Toby, Jake, Wes, thank you for taking the time to provide value for our audience here today.
Yeah, I can't wait.
So, gents, the first topic here of today, that is to talk about the holy grail of investing. So, Ray Dalio is one of the billionaires that we have studied most here on We Study Billionaires. And one thing that has profoundly impacted how I think about investing was Ray Dalio's concept of what he refers to as the holy grail of investing. So in his words, it's 15 to 20 good uncorrelated return streams that will dramatically reduce your risk without reducing your expected returns. And one thing that Dalio highlights is that individual assets within asset class can usually about 60% correlated with each other. So even if you're diversified, but it's still in that asset class, perhaps you're not. So this type of thinking is very different than how many people often think about investing. So generally, many investors have the home as the primary asset. And then with any excess capital, they consider typically two different investment approaches. I know I'm really generalizing here, but you have one who are more active. Very often that would be in the stock market, where that person would then pick individual stocks, typically in their home country. And then you have a more passive investor who would buy an index fund, but that's also very much in their own country and typically a market-weighted index fund. So that's sort of like the premise for the first question here. So if I can throw it out there, perhaps starting with you, Toby, do you apply the holy grail of investing mindset with 15 to 20 good uncorrelated assets? And you're already smirking here. And you could also say this premise that Ray Dalio puts up it's not really valid.
The premise I think is right. That's the general idea, that you want as many different uncorrelated return streams as you possibly can, so that your savings generally grow over time, whatever kind of environment you confront. If it's a 70s stagflationary, gold running, equities getting smashed to pieces, bonds getting smashed to pieces, then you want to have something in that portfolio that's keeping your purchasing power at least up with, with it, keeping it flat. And then you've got other scenarios where you've got like a late 1990s bull market, or the bull market that we've just seen in equities. All of those things are unpredictable. And so it's good to have those return streams. That said, I don't do that because I'm a equity guy, and I only run equities, and I'm only going to be exposed to equities because I eat my own dog food, so I'm only invested in the things that I do. So I think it is a very good idea. I think it's probably a better idea. It's probably more important as you get older and further into your investment or into your saving career. But I think that early on, it's all right to have a little bit more exposure to the things that you think are going to work a little bit better, and to concentrate and figure all that sort of stuff out. But probably Wes is your man for uncorrelated return streams.
Yeah, I mean, I might speak to that because I used to teach portfolio theory back in the day, and I didn't even know what I was telling these poor students. But like going back to basic portfolio theory, the whole concept, like Harry Markowitz and then leading to CAPM, all the bullshit that follows, is that, yeah, you just pull a bunch of uncorrelated stuff together. And even though they may all individually like go all over the place, when you pull them all together, all the randomness goes away and you just make free money. And if you can use leverage, it works even better. But there's two key assumptions that everyone learns. One is it requires leverage, right? And then the second one is that when the world blows up, the correlation structure stays the same. But as we've already learned, and people always relearn, is leverage is not stable, because when shit hits the fan, you don't have access to it anymore. And also when, SHIT hits the fan, is a lot of things that weren't uncorrelated become correlated. So I'm just, now that there's really two asset classes, and, Chris Cole, who's Toby's buddy, he's very good at explaining this. It's either your short vol, like you're winning when things are stable, or it's long vol, like it's losing when things are stable, but when the world blows up, it tends to goes up. So I'm a big fan of diversification across two asset classes, short volatility asset class, which things that work when the world's doing okay, and then long volatility asset class, which is things that usually don't work, but work pretty well when, you know, the world's on fire, is how I think about it. So.
I'm coming from live this week from Capital Camp, so I've learned that the only real asset classes are NFTs, blockchain, DeFi. Everyone is that's a very popular topic at the moment. So, no, I think that the other part of I totally agree, by the way, with what both Toby and Wes said. But I think another interesting way to kind of reframe the question is, like, do you really know what you're buying or not? And you know, if you're kind of a know-nothing investor and you don't plan on wanting to figure out what you're truly owning, then I think trying to find diversified streams as much as you can makes sense. However, if you are if you want to sort of understand what you own, the businesses, or whatever product it is, I think that then diversification often ends up becoming diversification, and it's just a different mindset and a different way to, like, there's lots of ways to do this game smart. It's just you have to sort of match up your personality and what you want to work on with the particular portfolio, and not trick yourself into thinking you're doing one thing and really you're, you know, playing a different game.
Yeah, and I think you bring up a good point, Jake, because like I mentioned before, most people have the vast majority of the wealth in their home, and you know that's something they understand, that it makes sense, and it's a different standpoint than say Ray Dalio, where I don't know how many homes he has, but you know it's probably a very small proportion of his net worth that's tied into his homes. So I can definitely agree with that. But if I can throw it all back to you, Tobin, you said, you know, your equities only, and you know, I think a lot of people feel that way. Perhaps they have their home, but in pure equities. I think even Warren Buffett said like he would put like 90% in the S&P and then 10% in treasuries. But are you at all worried that we're gonna have a, say, 1929, and it took 25 years to recoup, you know, that loss, just because your analysis was wrong? Like 25 years is a huge price to pay for being wrong in opportunity cost. Is that something that you considered?
Yeah, there's a huge risk that equities, particularly US equities, are the most overvalued asset class in the world, and that the consequence of that overvaluation is a very extended period of, I think when I look at the S&P 500, if I use that Hussman method, I know that that's you're not allowed to say his name, but I like his method for valuing the S&P 500. He says, let's assume that over a decade we go back to the long run average valuation, and you still get the underlying growth, which is about 6% a year, and you get dividends on top of that. Where you end up in 10 years if you follow that method. And at the moment, the last time I looked, it was predicting forward returns of about 0.8%, and that includes 1.3% of dividends. So that's a negative 0.5% on the index, compounded annually for the next decade. Now, it's been predicting very low returns for a while, and none of those have eventuated. So you can do what everybody else does and sort of discard those, or you can look at the reasons why that has happened, and that's largely that the multiples have expanded faster than earnings have grown for a very long period of time now, an unusually long period of time. And often so when you get this overvaluation, the consequence is lower returns and more volatility. So yeah, I think that's a very real risk, and I think it's probably, pretty good bet that at some point that's exactly what's going to happen. Having said all of that, I think that I'm a value guy. I'm looking at individual names, trying to figure out if I can figure out what this thing is going to be worth in 5 years' time. If I can buy it at a price that gives me a reasonable return based on what I assess the risk of that thing over this period of 5 years. And then I'm trying to get some diversification in that portfolio by having exposure to, I might have exposure to precious metals miners. I might have some exposure to some tech companies. I might have some diversification within equities. And I think that, if you look at the way Buffett's got diversification through Berkshire Hathaway, he's achieved that by holding equities. And even though there are periods of time, like he's written about it in the 70s when gold kept up with Berkshire Hathaway, which was, run by the world's greatest investor. So you just went and bought the hunk of metal that he despises so much, and it did just as well as Berkshire did. That's a pretty good argument for having some diversification to different things. My own circumstances are a little bit unusual in the sense that I run a fund. I run two funds, and they're equity funds, and they're exposed to the US mostly. So even though the earnings of those funds are not necessarily derived exclusively from the US, there's pretty good international exposure to those equities, to those earnings. Ultimately, the valuation placed on those is largely going to be driven by, the domicile, which is the US. So I have to sort of run my portfolio, my personal portfolio, the way that I do because of the circumstances that I'm in. I wouldn't necessarily do it that way if I wasn't doing that. But to answer the question, yes, I do think that's a very real risk, and yeah, I do think about it a lot.
So sorry, Jake.
I was just going to say that one thing I see a lot is that especially if you happen to get stock options in your job, I see a lot of people that end up making big bets on one individual company. So not only is your kind of future stream of your income coming from that company, but you get a big equity investment in it through your options. People can get very, very concentrated into one particular company, and I mean sometimes that is how you could make quite a big amount of wealth, but you can also take extreme risk. The other thing I would say is that I think people are probably making a lot more interest rate bets than they might realize. Like your house is, if you own your own house, is a pretty long duration asset with some leverage on it. Like you're making a reasonably high interest rate bet that rates will probably stay low if that's a material part of your net worth. Your equity portfolio is probably also, especially the longer term out the cash flows are from today, which has kind of been like the winning idea for the last 10 years, then you're making kind of an increasingly more of an interest rate bet that rates will stay lower for longer. And I mean, I have no clue as to which way those things go, but I do know that you are making a bet on that implicitly in any investment that you're making. And it's something to really be mindful of and not just totally let it, be oblivious to it.
Throw it over to you there, Wes. Assuming that you wanted to diversify away from a market cap weighted, say called global fund, let's say that it's just our home country, so we're already global. Which investing strategies would you follow, or which assets would you add to your portfolio if you bought into this holy grail of investing type of thinking?
So again, going back to like what's short volatility, what's long volatility, on that short volatility book is what are things that do well during normal times? Well, that's your house, that's your human capital, that's your stocks, that's your pretty much everything most people own, right? So within that bucket, I like to own cheap stuff, and I like to own behind them, right? And right now in particular, just because I've been in the weeds of it, like value, in my opinion, is evergreen, right? Buy with the margin of safety. So I would not want to buy passive indices right now, because if you look at whether it's a US, index, SPY, it's probably got like an operating income yield of 5%, which is crazy. And then international markets, maybe it's 6%, and EM, maybe it's 7%. Like all of those are extremely expensive if you just buy the market cap indices, which is fine. But if you go into like cheap stock world, in the US market, you could probably get stocks that are still, 10 to 12% EBIT yields or operating income yields. But if you go into dev markets or EM markets, you could get like 15 to 20, right? So there's 2 times as much kind of bang for your buck opportunities in the value world out there in international markets. So I just think there's a lot more opportunity. If I'm going to own short volatility, i.e. own things that blow up when the world blows up. At least I want to own things with a margin of safety that, I feel have like higher expected returns. So that's what I do. Buy cheap stuff in the States and globally, and then we like momentum stocks as well, because I got to hedge against the fact that, maybe value stocks do get burnt to the ground. So I just buy cheap stuff and buy winners across the globe for the short volatility book.
Value stocks are like a smoldering pile of rubble at the moment. Not that you think they can burn down further from there.
I mean, I don't think so, but as you know, like I've learned enough in lifetime to not believe in only one religion, because sometimes a religion is just wrong. And so I just diversify against the religions. Like, obviously I believe in margin of safety. I believe in fundamentals. I believe in free cash flow. I believe cash is king, but I also understand that, like, Jake's at a conference where they're talking about NFTs and all kinds of crazy bullshit. They have nothing to do with like cash flow and dividends and fundamentals and net present value. So I don't know, maybe we're in a world where, and I think this is crazy, but maybe we're just in a world where people don't care about valuation. They care about flipping it like Ponzi schemes, basically. Flip something that's shiny now that's going to be even shinier in the future to someone else who wants to buy it at a higher price. Also a valid investment approach. And so I'm with you, Toby. That's why I like value, but there's a risk that maybe fundamentals just won't matter for a lot longer than anyone can expect. I need to hedge against that, basically.
So Jake, let me throw it to you. I always know what Toby's going to say, because he's an equities only guy, right? So
He's a broken record.
He's a broken record.
Man with a hammer.
Right. So, Jake, what would you do? Other strategies, or would you have any specific type of asset classes that you would add to your portfolio?
I mean, I'm kind of drawn more towards trying to keep things as simple as possible. So, like, I structure things for my clients actually where it's basically like if you're going to need any money within the next 5 years, we're not going to invest that part of the portfolio. And anything after that tends to be equities. I would be open to bonds if I found things that made sense, but it's just, I mean, kind of in my lifetime, well, early in my life, I think there were probably bonds, but I wasn't doing a lot of trading as a toddler. But for most of my professional life, bonds have seemed to be kind of high priced to me, and especially relative to what equities would offer over a long-term holding period. So I tend to end up with kind of a barbell strategy where there's a lot of cash and liquidity for any needs that a client would have in the next 5 years from that portfolio, and then everything else is eligible for a long-term hold equity type of investment. And that's just the way that makes sense to me and is simple. And so if you have more than 5 years, let's say, until you'd ever need to draw on that portfolio, then like all of it would be theoretically available for equity deployment. Now, we can argue the timing or not with that cash and the pitfalls and that, but yeah. So I tend to have a fair amount of cash and not a lot of other more esoteric assets.
It's interesting that you would talk about that, Jake. So I had Toby on the show here not too long ago, and we talked about having a cash position. We talked about inflation and how we might think differently about inflation. I don't know. I don't want to put words in Toby's mouth whenever I'm saying this, but I sure think differently about the opportunity cost than whenever I started. Well, I was taught, the Church of Buffett and Munger, I'm supposed to have a ton of cash around, and then I would then invest whenever that brilliant opportunity came along. Not a lot of brilliant opportunities really came along, and so I kind of also felt I paid a high opportunity cost with everything we see now, not just in the macro landscape, but just in general with the market right now. Well, you already said that you have a fair amount of cash. Like, is that like 10%, 30%? Like, and how do you think about inflation when it comes to that?
I honestly, I kind of view this as a poker game in a lot of ways, where the amount of cash I'm holding is like the chips in my stack, and then there's an ante that is, the blind comes around to me and I have to pay, and that's sort of the inflation. And I've been very, very thankful that the blinds have been low for a long time of this poker game, and it hasn't been that painful. Granted, the opportunity cost has been big, but even then, I mean, it's not like value ripped and I didn't. It's not like most of the S&P 500 didn't really do anything. It was only a handful of things that have really done it, and I was not in a place to appreciate those businesses, and so I didn't really deserve to get the gains from those. So there's always going to be things I don't understand, and if those do well, then it's like that shouldn't really bother me. So I've just been very, very thankful that the ante of this game has been, or the blinds have been low, and it has not been as painful as it could be, period, to be on the sidelines.
And Wes, how I remember we talked about this, some time ago in terms of ETFs, and generally you want to be fully invested. How about you, like in your private portfolio? Are you sitting like on a pile of cash waiting to deploy it whenever you see more attractive assets?
So to Jake's point, like cash is fine. In my opinion, it's a costly insurance vehicle, and there's potentially better alternatives out there that achieve the same end state, really. Because what cash is doing for you is it's creating optionality to be money good when the world's on fire. But the cost is you got to sit in the bank account, and you have the opportunity cost of capital and inflation, all this other stuff. And so the ideal situation is, how would I get access to insurance cheaper? And I'm not saying that there's only one way to do it, but I'm just a huge fan of using, like, obviously trend following techniques where, maybe you only put down the insurance if we're in a bad trend. There's a lot of times you can buy like different, like long volatility products in option world, where you can find people that, they're going to have some cost to carry, but it's not that high. But when the world blows up, you get paid. And so now, it's like buying insurance, but the insurance premium is not that high. So I'm just a huge fan of trend following in general, like managed futures, which is, specifically trend following managed futures, just straight up long volatility, like owning puts, but smartly, I could see working. And cash is also fine too. It's just, so I would say you probably want to do like a mix of all those different things as a ways to kind of counterbalance your all-in equity book. And so that's what I do personally. I don't have cash sitting around. I got managed futures. I'm not going to mention it, but I own this fund that does long volatility, and I do trend following. But for the most part, I'm long and strong, our funds on the equity side, like Toby does. So I don't hold cash in big quantities.
I think the other part that's important for me is that, most of this game for me is trying to control my own psychology. And I really do feel like it's sort of me against myself often. And the cash is a way to really help me to stay patient. And there's a comfort to it that I think makes me a better investor. And so even if it's kind of suboptimal, the simplicity of it, like I believe in those things too, Wes. Like, I mean, I think, tail risk funds, things like that, like they make sense to me. But oftentimes I'm trying to keep things simple so that my mind can rest at ease and I don't have to like do as many, and then I can really focus on like trying to really understand the businesses.
Yeah, you're doing it the right way. It's 99% mental game, 1% what you actually do. So if you're controlling the 99%, I think you're going the right method, 100%.
So let's talk about trend following. You just mentioned it there, Wes. So to me, I've never invested in anything that was trend following, but I read up a bit on it here lately, and it seems to me to some extent to fit the bill of the holy grail of investing. I don't have 15 or 20 different revenue streams. Like it would be great if that was the case, but that's not the case for me. And I was thinking whether or not trend following would really fall into that bucket, because over a long time period, it's not correlated with the stock market. It follows a lot of different and uncorrelated markets if it's set up right, and yet you can achieve stock market like returns. And you can invest in smaller funds. You don't need to put down a down payment as you would for your house. But it's and one thing that might make this appealing is that perhaps it doesn't matter if we are in the biggest bubble in history. Some people think we are, other people would argue that we're not. But in case we are wrong, the strategy appeals to me in the sense that you can make money in the direction the market is going. Obviously, you would then be very much long right now because of what's happening to more or less all markets right now. So if the stock market would crash tomorrow, you would still see like significant drop in your trend following portfolio. But you could then make money on the way down whenever that trend has shifted. So my question is whether or not you considered investing in trend following.
I have looked at it pretty. I like Chris Cole's version of the world where everything's long vol and short vol. As I point out to Cole, when you long vol, you still got to figure out which one of the long vol assets you want to be in. It's not quite as simple as that, but he knows that too. He's written some good papers on that. But I like the way he thinks about the world. But the other, the idea of trend following is just that, well, the simplest version when you apply it in an equity world is that when you get that precipitous drop, which you do, which is like the tail end of most bears, when you get that big, gigantic sell-off that kind of ends it, that you're like magically plucked out and you're hedged through that period. And you can find lots of examples that work really, really well. You can run S&P 500 back and use like the simplest versions, the 200-day or the 10-month, which is the one that everybody recommends. And you can see how well that's done. Apply that same methodology to Japan. The beauty of it was that it kept you invested the whole way up the Japanese bubble as it ran up in the late up to 1990, and then it just plucked you out at the top. And as Japan was absolutely devastated, you survived, and you've kind of done much better than anybody else in Japan by following these things. The problem I have found with them is just the implementation of them is very difficult. And it's not a total solution in the sense that you do have these, trend following hasn't been a great strategy over the last, Wes would know better than I would, but it hasn't been a great strategy over the last sort of short period of time in the market because we've been whipsawed quite a few times. As the market goes down, you put the hedge on, market goes back up, you hedge, take it off. It's just, that's every single trend following strategy that I have a look at Corey Hofstein's dashboard where he tracks these things. Any of these risk managed strategies like buying some vol, trend following, being a value guy, holding cash, everything has underperformed for the last sort of 10 years because the market's been very, very strong, and the harder the chewer, the longer and harder you've been through this whole period, the more likely you've outperformed, and any kind of risk management has hurt you. And so it's always at this point where people are like, well, I've been doing this shit for 10 years and now I'm underperforming. I'm going to give it up and I'm just going to be long and strong. I might even get levered long. And I think that I kind of get the feeling that, and I'm going to buy some other stuff. I'm going to buy NFTs and I'm going to flip those, and Bitcoin. And sorry, Stig, I know you're a Bitcoin guy, but I don't like assets where the basis of the valuation is what the next guy pays for it. I like assets where the basis of the valuation is something that I can individually just go and have a look at the underlying business. And then if the mark gets changed tomorrow by 50%, but the underlying business is the same, then even though on paper I'm 50% poorer, I know that the underlying business is still great, and that might be a good signal for me to buy some more. So I approach it like that rather than I'm at the point where I just want to simplify my life. I don't want vol, and I don't want trend following. I don't want other things in there. I'm just trying to get to because I'm okay with a 50% drawdown in the market. I'm happy with my investable assets going down by 50% because I'm not using them for at least 25 years and probably longer than that.
That brings up a really good point, Toby. I think, a lot of these things are, like Wes said, they're kind of insurance products, right? And one of the things that you're sort of insuring against is quotational risk, like having the prices move on you and then you not being able to kind of handle it psychologically and maybe making an unforced error. Well, if you know what you own and maybe you have a lot of cash that you feel good about deploying at that time, which sort of softens the blow of watching your other holdings going down, right? Like you can get excited about the new things that you're buying for cheaper. And you can stomach the volatility and the quotational, like you could self-insure that quotational risk. And I think that's
both directions too, up as well as down.
Yeah, right. So I think that's how I view it, is like I'm trying to self-insure that risk rather than look for someone else to insure it for me.
So if I can ask you then, Wes. So whenever people are hearing trend following, perhaps they're thinking which 5 stocks have spiked here recently, they should run out and buy that, or like I just like to debunk any kind of myth.
Let me.
Yeah,
it's like a lot of things. Like, oh, I'm a value investor. What's that mean? Like, do you own Amazon? You could be a value investor. Like, so it's really important to define what you mean, which is basically your question. So there's a million flavors of trend following, and I'll talk about 2 that are kind of the most important. The first form of trend following is just long-term trend following for risk management, get out of the way of the car wreck trend following. And that's where the basic idea is, and we've studied this on every asset class that you could possibly get data on, and it works everywhere in some sense. Where what you're going to do is you look at a risk asset class. If it's in a long-term trend, own it. If it's in a long-term downtrend, get out of the way. That's simple. Why do you do that? Well, almost all left tail events of 50% type drawdowns are going to occur, obviously, in situations where this asset class is in a poor long-term downtrend. And so you can apply that on every single market, over every single data set across time. We've done it. We got all kinds of posts about it. But we have a really important post called Trend Following, the epitome of no pain, no gain. Because to Toby's point, if you think value investing is hard or momentum investing is hard, how are you going to feel when you're running like a trend followed equity strategy and you've underperformed for 20 years? Not that great, right? And a lot of times you're in cash while your uncle's like, he's doing high fives on how the S&P's up like 5 times, right? You're going to feel like an idiot. And trend following it is the most painful trade possibly that I've ever found on the planet Earth. But it also is the trade that I have the most confidence in for long-term survival. Follow trends is a good way to survive, because by definition, if something's working, you're in it. And if not, you're gotten out of the way. So it's really hard to lose your ass, basically, in just general trend following. That's one form of trend following. It's very simple. You could apply it on your equity book or whatever. Easy to implement, whatever. The other form of trend following would be things that are supposed to deliver what they call crisis alpha. So where the prior form of trend following, which is just long-term, super simple trend following, is for risk management purposes. It's not going to prevent you from losing money. It's just the idea is it may prevent you from losing over half your money and maybe only lose 20 or 30%, but it's just risk management. Crisis alpha trend following is much more high frequency, usually runs long, short, and goes across like commodity complex, bond complex, and everything else under the sun. Those systems are designed to, in general, on average, you don't do anything. You just get chopped up to death in frictional costs, and you may make a little money, you may lose a little bit of money, but they're designed that when shit hits the fan to actually make money in the stock market, i.e. why they call it crisis alpha. And that genre of trend following systems, which is generically called like managed futures, is you may be daily rebalancing or weekly rebalancing. You're going to use much shorter time window trends, like maybe do like a 100-day look back as opposed to like 250 or 300-day. And again, it's just, those are designed not to make you money, but just straight up insurance, right? And they work. Like, we run them, like they go up when the market totally blows up. But the problem with those, of course, is you get destroyed in frictional costs. They're super hard to understand. If you don't know what you're doing, like to Jake's point, you probably shouldn't be invested in it. So I'm a huge believer in managed futures for crisis alpha as well. But I would also am a huge believer in behavior drives everything. If you don't understand what you're getting into, if you don't know why and how it works, you should just put money in cash or bonds and do your diversification that method. But anyways, so those are the two types of trend: long-term trend following for risk management, keep it simple, stupid, and then high frequency, more complex, trade a lot, trend following that's usually deployed across tons of assets in a long short context. Also cool, but not for everybody.
And could you provide some numbers if you've done some research on it, like how different portfolios have done with, say, trend following taking up 5 or 10% of a portfolio, and then also like perhaps if few thoughts on should you diversify within trend following if you do allocate, say, 10% of your portfolio into trend following?
Yep. So in general, for like the risk management form of trend following, like let's say you want to own equities, but you don't want to get your face ripped off at some point. Anytime you deploy long-term trend following rules, they don't trigger that much, right? So de facto, you're basically a buy and hold in the asset class, but it's only in protection for like extreme events. So usually when you look at those time series, whether it's, Japanese stocks, Australian stocks, or whatever, it doesn't really matter. You're going to typically achieve close to the same expected returns with half the drawdown. However, that's just back testing. I always tell people, listen, you're buying insurance. So you probably shouldn't have an expectation that over a long-term cycle, you're going to get the same expected returns with half the drawdown. We say, hey, you're probably going to get a lot of the expected returns, maybe 80-90% of it. And yeah, you probably will protect against, the big kahuna drawdown, but you're going to be eating massive behavioral pain because like the relative performance thing, because there are no free lunches. So that would be my expectation for like a long-term trend. It's basically buy and hold with an airbag, right? And you're going to probably get half the drawdown with, maybe 80-90% of the upside. Now on real trend following, like the more high frequency crisis alpha version, where you're trading, whole commodity complex, gold, silver, palladium, blah, 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 like the more complicated kind of managed futures products. Those strategies, I would say, are not going to be able to contribute. I mean, they do in a back test sense, but a lot of times that comes from like the historical benefit of you put the cash in a T-bill that used to make money. Now they don't make money anymore. What I always tell people is I would not expect a high frequency crisis alpha focused managed futures fund to make a lot of money. It's probably going to, if you get flat, that's awesome. But if it provides that insurance where it goes up 10-20% when the world blows up, that's insanely valuable. And if you're not making anything, if you're basically getting insurance and you don't have to pay for it, that's awesome. Is the best way to kind of think about these things. Now, as far as allocation, what I always tell people is, okay, you got 80% of your book in stocks and you're going to do a 5% trend following allocation. Well, if 80% of your book is in stocks and they go down 50% and you put 5% in managed futures and you expect it to really do anything, you're just insane. And so the weirdest thing, and I actually personally run my book like this, even though it's totally insane, is managed futures exposure should be a massive component of your book because you need to counterbalance the equity book, right? Because if you're 80% stocks and 20%, let's say you're aggressive managed futures player, you're still, 80%, 90% of your risk is short vol and you have a little bit of protection. But if you really want to truly balance like the chaos, you really need to be more like 50-60% managed futures program and then 50-60% in equities, but no one does that. So in my opinion, a 5% allocation to trend following or managed futures is just a waste of time. You might as well just put it in cash and just, feel warm and fuzzy. Anyone can understand cash. Like I would say it's either a go big or go home trade. You either believe it and you do it or just hold money in cash and move on. But that's my personal opinion.
There's a lot of implementation with, I think of it like crisis alpha, and I think crisis alpha and the sort of, I think that the trend following, correct me if I'm wrong, Stig, but the trend following that you're sort of talking about that 200-day, using it as a hedge against a big drawdown, and then comparing that to something like crisis alpha, which is someone who's long vol. in the futures or the options, and they're going to give you on the big drawdown, it's going to give you the big payoff, and you're sort of hoping that they achieve the same thing. The two things to watch out for, if you're exposed to that, the crisis alpha particularly, if you have that big drawdown, as Wes points out, these things mostly they just break even over long periods of time. Well, that's a great manager who gets you to break even over time. The advantage of it, the reason that you do it, is that you have that monster drawdown. All of a sudden your third pocket appears and it's got a whole lot of money in it. But then to take advantage of it, you have to be able to get access to that capital and redeploy it long and rebalance your book back to that starting setting. And if you can't get there, then it hasn't performed its function. It's sort of just, it's popped up when the market was down and you felt good, but you didn't achieve anything. It didn't get you any further ahead. The thing with the trend following, the longer term sort of risk managed stuff, you have to understand what the thing is, and you have some implementation risk in that as well, in the sense that when like a March 2020, I don't know which ones worked and which ones didn't, but there will be trend following funds that, if they're a very long term and they're checking in once a month, are we on or off for this month? And there's nothing wrong with that. If you do it more frequently than that, you might find that the challenge is always how much of your cost over time, how much of you're burning on premium, or how much you're burning getting whipsawed versus your payoff. And you have to kind of decide. You may be able to do a 5% allocation, but you got to recognize that 5% allocation, so you give it to someone like Mark Spitznagel. Mark Spitznagel is probably going to burn your 5% allocation over a month or so, and you might have to re-up again for the next month or two with another 5% allocation, because that's what those things do. They've got this extreme positioning that the premium bleeds off really quickly, and so it goes to nothing.
I think it's more to like 2 to 3% per year, but
per year.
Yeah.
Sorry, Mark. I didn't mean to suggest it was as high as that, but I have seen. I mean, I've tried to do it. Long vol, vol options on futures balanced against a value book. That's a terrible idea, because you can have this period of time where both sides of your book are underperforming, and if you don't get the big payoff, then you're just burning premium for a decade, and you end up with that. You've achieved the same outcome where you're down 50%, but you haven't had the big drawdown. I'm sort of with Wes in the sense that there are no free lunches. You just have to kind of get comfortable with your own personality and the function and implementation of the tools that you're using, and recognize what they do, and know that there's always a risk that you do all this risk management for a decade, and you get to the same point that you would have been being down 50% or underperforming by 50%. So all of that said, that's kind of why I've gone back to just trying to simplify my life as much as I can.
Do we have time for, speaking of that third pocket, do we have time for a quick story of one of the best third pockets I've ever heard?
Yeah, let's do that.
So it naturally comes from the GOAT, Mr. Buffett. It's the depths of 2008 drawdown, and everybody's losing their minds, right? The world's coming to an end. Warren sells puts, $5 billion worth of puts. He gets the money that second that he can go do whatever he wants with. And those puts, the way they're structured, no collateral required, no European style option. So, and the average duration is 13.5 years from 2008. So even if the S&P was down like, I think 40% from there, right? And this is all nominal as well, right? So like 3% inflation alone, and even retained earnings is going to carry you well above probably wherever it is flat for that, 10 or 15 year period. He gets like the cost of capital at that point for him would have been about 4. And that's if the S&P was at 40% below in 13 years from 2008. I mean, just one of the absolute all-time amazing third pocket plays that I've ever heard.
And he didn't have to pay for it beforehand.
Nope. Money in the door that day, while prices, were at the best that at least I've probably seen in my lifetime.
Yeah.
Wow.
Well, one thing I wanted to add here real quick, is Toby brought up a genius point that most people forget, is if you're going to do diversification, you're going to do crisis alpha, you're going to allocate these long haul things, You have to rebalance into the world that you own that blew up. And I've noticed this time and time again. People are like, oh, I just own 60% of this, 40% of that, buy and hold. No, doesn't work like that. Like you need to, the whole point is you got to be able to actively rebalance and take advantage of your third pocket or your cash. And if you're not willing to do that, it's an even worse idea. Like I'm sure Jake here, he's got his cash, but he's got a plan and a program and a system that when the world blows up, he's ready to use it. What most people do is they have their crisis alpha, they have their cash, world blows up. I just need to hold that cash. Man. I can't. So unless you have a plan to actually take action to implement on the whole point of owning crisis alpha, it's also a waste of your time, which is something that Toby brought up, which is hugely insightful and important to reiterate here. Like it's not buy and hold. You have to actually do stuff when the world's on fire. Otherwise it's, just go in Vanguard funds, have a nice life.
Yeah, Wes is totally right. I mean, having, there's this idea of like a Ulysses contract. And if you remember, Ulysses was this explorer and he was sailing, this is mythology, so it's not a real person, but, and he was sail past the sirens and they wanted, of course their singing would draw the captain of the ship to steer into the rocks and crash, right? And that's how all the sailors died. So what Ulysses did was he tied himself to the mast so that he could still hear the sirens, but he couldn't turn the ship. So you need to probably create some Ulysses contracts with yourself about, if something gets down to this price, I'm going to buy it. I even prefer to do it for myself with like valuations. Like I like this company. If I ever see it at 8x, whatever multiple, I'm going to buy it. Right. And I keep track of that. And I think that's really like, make these plans while you're sober, while there's not headlines filling your mental space, while it's quiet and easy to think about it, and don't wait until you're in the heat of the battle. I'm sure Wes, that saying about like, the more I sweat in peace, the less I bleed in war, right? Like, and I think I'm trying to sweat right now while it's peaceful so that I don't have to worry as much about it. And I just stick to the plan. I know it's a good plan because I put it together while I was sober, right? Don't wait until you're in the middle of the shit to like come up with, okay, what do we do now?
All right. So guys, I think this is a good segue here into the next topic about active and passive investing, emotions, all the things that comes with that. So it seems like these days that there are more active retail trading that ever. If we let me just start by giving you some stats here. So in 2019, we had 59 million Americans who had accounts with one of the 7 largest brokers, and that number has since surged. We are at around 96 million, and 20 million of them were just opened here in 2021. And so if you look at the total trading flow, retail is an all-time high with 40%. So still, with all of that being said, we still see passive investing on the rise. If you look at the S&P 500, 18.5% of that is held in passive ETFs and mutual fund indexes. So we've seen what looked to be a secular trend for decades. And so even despite this surge in retail trading, we've seen more money be invested passively. So is that an advantage or a disadvantage? Let me throw it to you, Jake. If you have an increasing share of the funds being invested passively, and I ask you because you pick individual stocks.
Yeah, I was just worried I was going to have to go first.
I'm so glad that was you.
So, I mean, a couple things. I think I'm very ambivalent about the rise of all the kind of like call it Robinhood effect for lack of a better term. On the one hand, I love the idea that young people are investing, taking an interest in owning businesses or and like saving money and putting it to use. And I think it's terrific. I want to encourage that. However, I can't help but feel like a lot of it resembles gambling, and maybe by design, as far as some of the dopamine hacking that happens, and I find that to be very distasteful. So while I like the idea of the encouraging people to invest. The execution of it thus far in a lot of these apps has been, I find it to be disappointing. So as far as once the money comes in from outside and maybe like less sophisticated, is passive or active? I think for most people, unless you have a real active interest in wanting to get into this stuff and kind of live it, I think passive is a totally appropriate thing for you to do. Now, if you are into it, then I think like it's active is still very reasonable. And granted, this is some motivated reasoning for sure, because it's like what I like to do. But I think so there's like sort of two sides of the debate. Like there's the flow debate, which is like, God, if everyone's going into passive, they're just buying all of the S&P 500, let's say, and therefore that's the only thing that's going to like ever work and move. And if you're an orphaned stock that's not in an index that's getting passive flows, well, good luck to you ever being able to like recognize a good return. I think that is true in the short run, but a total advantage in the long run. And you have to have the faith that like what I'm buying today, even though it is an orphan and not part of indexes, the underlying business value is accruing. And the fact that no one is looking at it because they're just all passively indexing is an absolute godsend for an active investor. So I think that both sides of the debate right now have framed it as if, call it, like kind of Mike Green's melt up theory of that it's just, we're just going to keep going up and it's because there's just passive flows all the time. Yeah, I think over a short time period, that's absolutely true. But over the long period, you couldn't ask for a better setup as a stock picker, because if no one's looking at all of these businesses and no one's bidding them up, like that's my dream come true. So I think it's just, again, it's always about coming back to setting like what is appropriate for your psychology, what game are you playing, and then picking the strategy that fits with what you're trying to accomplish and where your strengths and weaknesses are.
Toby, do you dare answer that question?
Yeah, I would probably just reiterate what Jake just said. I guess that the two questions is passive in the sense that you're just investing into an index fund, and you've thought about your allocation beforehand, and you're getting some exposure to all of the right things. You've got your asset mix. That's going to be perfectly fine. You've already recognized that there are risks in S&P 500 has a risk of going down 50% at any time. International stuff's in the same basket. The bonds might underperform if we get some inflation or interest rates go up. There's no, just to keep on saying Wes's favorite line, but I 100% endorse it. There's no free lunch. There's no way to like protect yourself against everything or to outperform everything. The other argument about passive distorting the market or destroying the market, I'm kind of with Jake on this, and I've been saying this for a while. That this scenario is not new. You can find there's a Piper Jaffray article from like 1999 called "The Endangered Species List," and they followed up a year later with another one called "Darwin's Darlings." Basically, they were just pointing out, hey, look, with all this tech stuff going on, there are all of these Russell 2000 companies. So that's the smallest 2,000 out of the Russell 3000. And some of the ones at the bottom are pretty small. Look, there are companies that are growing their earnings or revenues like 30% a year, and you can buy them on an EV multiple of like 5. And this is crazy. And they were just pointing out the fact that this existed. And then from that, there was that activism and private equity boom in the early 2000s, where they all got taken private or they got approached by activists to have them do some sort of value enhancing maneuver. And then all of the action started happening in those smaller companies. And so, for a period of time, everybody in the market was a value guy and an activist. And that value did extremely well, and it attracted a whole lot of guys, probably like me and probably like Jay too. I don't want to hang you mate on that one, but we talked about it at the time where I was like, oh, value works all the time and it does really well. All you got to do is stomach those, the tech boom, like late 1990s, and they never come around very often. And here we are in another gigantic tech boom with people trying to justify why it's going to go on forever. I kind of think that when there's opportunities out there, you just got to take them, even if the market doesn't recognize it for a long period of time afterwards. So I think it's a good thing from a selfish perspective. Whether it's good for the market as a whole, I don't know. That's a slightly different question to the Robinhood question, isn't it? I don't know if we get off topic there.
No, let me throw it over to you here, Wes, because we do have a Robinhood question here, next one to go. But before we do that, I know you're really in the trenches with your fund, so I'm sure you thought about this question. It's something that I've, is it an advantage or disadvantage to the active investor that we now see this secular trend? It looks like it's going to continue.
Yeah, I mean, I think in the end, investing boils down to dollars and cents, not whether it's labeled passive or active. So the things that matter always matter: fees, taxes, and frictional costs. And so even though the best active strategy might be able to crush the soul of like the worst passive strategy, if the fees, taxes, and frictional costs aren't managed, you still might be better off doing passive, right? So that's something we always want to be concerned about on any investment approach. What are we doing, and what's like the net benefit to it? But I certainly agree with these folks here, and it's something that Ben Graham talked about 70 years ago. In the end, it's a weighing machine. Like, the facts matter. Like, it's not a Ponzi scheme. Like, at some point, cash flow and actual business matters. Now
when is that point, Wes?
But yeah.
When is that?
It might be the case that
I'm waiting.
Mr. Market is crazy for another 20 years, but at some point the weighing machine matters. And so that's something to consider whether you're active or passive. It's not whether it's active or passive, it's what are you buying? And fundamentally right now, what you're buying when you buy passive is a bunch of extraordinarily expensive, high gross prospect, high sentiment, it's got to be perfect to work investments. If you're cool with that, and go for it. If you have horizon, you have discipline, you believe in the weighing machine, and you can access the exposure cheap, efficient, after tax, blah, blah, blah. I personally think that, we're in a situation where the opportunity in active is actually enormous, but the cost of exploiting it is enormous in the form of behavioral problems, because there's very likely that, anyone who tries to, do something cute is going to have to sit for 20 years and look like a total idiot when your 5-year-old cousin is like, why don't you just buy NFTs, dude? So, I mean, that's the trade-off. Like, to Toby's point, there's no free lunch. You get excess returns, but there's usually some either direct or indirect costs associated with exploiting it. So, yeah, I think it's all an age-old debate that, people have forever. But the weighing machine matters in the end, after fees, taxes and frictional cost.
So, Jens, I really look forward to asking this question. So, Charlie Munger has said of the commission-free trading app Robinhood. Yes, it is one of those episodes where we're talking about Robinhood. And so he has said it's a gambling parlor masquerading as a respectable business. So let me just tee up to you. Like, Charlie, tell us how you really feel, right? Jake, do you agree with Charlie, and is there a silver lining?
I mean, I tend to directionally probably agree with Charlie. The silver lining, I think, is it's like Wes just said, like lowering the fees on any product like that should hopefully leave more meat on the bone for the investor. Now, whether the hidden fees of front running or whatever it is that how by selling order flow, what that actually takes a bite out of the meat that's there for the investor. I'm not sure I even know what the answer to that is, and I don't know how much that skim costs, but and it does feel a little disingenuous to say that it's commission-free trades, which, okay, that is true, but it's not free trades. Like, those are two different things. So don't say free trades. That's not true. It's commission-free trades. But yeah, I mean, like I said already, like it's certainly and this is my own bias speaking of how I see the world and how I want to do this, but it does encourage a short-term kind of, behavior, I think, through, and probably too active of a trading relative to probably what the research would suggest is a good cadence. But again, those are, I'm revealing my own biases more than telling you anything new.
Toby?
Yeah, it's a modern day version of the bucket shops that were around in Jesse Livermore's day, where you can get access to margin, and they've simplified it. So do you think this is going to go up? Then buy this thing, which is an option, which up over what period? A week, a month, a year, 10 years? Like, there are some businesses that I feel reasonably confident will be bigger businesses in 5 years' time. Whether that stock price is going to be higher at the end of the quarter or not, like I flip a coin, I've got no idea. And I don't think that there are very many other people who have figured it out either. Maybe Jim Simons figured it out, but I don't think there are very many other people who've figured out that short-term stuff. Yeah, I don't really like the way that they've set it up to encourage people to overtrade, because I think that it's people who are in a lot of them are in desperate straits and they're looking for some way out, and they're using that as their way out. And I think that ultimately they'll probably get hurt. And then the silver lining might have been, well, it's drawn all these people into the market who wouldn't otherwise be in there. But if they get burnt really badly, are they going to come back, or are they just gone forever? And, ultimately you're better off viewing it as like a savings vehicle that you save into over time, and you get growth in the underlying assets over decades, not sort of weeks or months or quarters or even years. So yeah, I don't want to rain on anybody's parade. If you're having fun doing it, then have fun doing it. But just recognize that there is also a downside, and we haven't seen one, since March 2020, when a lot of these people have come in post that.
So, Wes, you don't come off as the stereotype of the person sitting on your phone all day trading 14 days options on Robinhood. But do you, because I see you not there with the criticism of Toby and Jake. Is there anything positive to say about this development we're seeing right now?
Not really. And the way kind of. So I usually explain to people like, hey, investing is 99% behavioral, 1% operational. And on that 1% operational, this stuff is amazing, right? If you're an investor, your fees, your taxes, and your frictional costs are insanely low via, these brokers, ETFs, what have you. However, you have a huge benefit on the 1% of investing, but on the other 99%, the behavioral side, the costs have been magnified, right? You can now trade for free. You can trade seamlessly. Anyone can access the information, which just encourages decision-making and activity. And so I think on net, it's probably going to be the most painful, atrocious, money-losing exercise that, a lot of people will ever go through for the rest of their life, unfortunately. But like Toby's point, it'll be a good lesson. I used to do that. I used to gamble all the time, lost my ass, and now I learned not to do that. So everyone's got to touch the flame sometime, and I encourage people to do that when they're young and kind of broke, because if you get some resources, you don't want to start doing that, because then you lose the whole kitty. So there's costs and benefits to everything, basically.
I think one of the reasons that that real estate has been traditionally a pretty good wealth building vehicle for a lot of people is that because the transaction costs are so high and it's hard to get in and out of. And I think for the average person who they can make their mortgage payment and it turns into sort of a forced savings vehicle, then like they basically, borrow $300,000 and then pay it back over time, and you get $300,000 at the end. So, this is very much the opposite of that. But yeah, I mean, like you said, if you're diligent and like I view that I'm building my little empire every single day, and like the fact that I can create and tear down my empire in whatever the image is in my head of what it should look like for almost zero cost anytime I want to do it is an absolute amazing thing for an investor. But like any tool, it can be used for good or not evil, but for you're not for your benefit. And so you just have to be very careful. Just like you wouldn't give a scalpel to a 2-year-old because sure, we do surgeries with scalpels, but you could also disfigure something. And I think that these tools now are very powerful in a similar way and can be terrific if used correctly, but also dangerous if abused.
Well said, Jake. So here for the last question here of this round, I wanted to throw it over to Toby and Wesley, perhaps starting with you, Toby, because we often on the show we talk about individual stock picks. We don't talk a lot about ETF investing. So I wanted to ask you, now that we have both of you here, what's the best and the worst thing that has happened for retail ETF investors in recent years?
The change from this is sort of a technical thing, but the passive ETFs had a capital gains tax advantage over active ETFs that got removed in the last year. So an active ETF can now be run with the capital gains tax exemption, which it's the main reason that you run an ETF, or one of the main reasons. It has this liquidity, which is fantastic for investors, that they can get in and out multiple times through the day if they want to. And then the trades of the manager don't create capital gains tax implications for the person holding them. They make their own decisions about when they incur those capital gains tax. So I think that stuff is fantastic. It makes them, I think they're the best vehicles. I think that makes them better than mutual funds. They're better than LPs. They're better than managed accounts. That from that perspective, they're great. And I think that there's the active change will see a lot more managers who had been in mutual funds, or even managers who've been in LPs. And I know a few who are doing it, who are transitioning across into an ETF structure, which means that anybody would be able to get access to them, where previously you needed to have some sort of asset level. To be in an LP that was going to charge you a carry, which a lot of these guys want to do, you need to be an accredited investor, which is they've just changed the threshold recently, but it's like millions of dollars in investable assets, which most people don't have. But you'll be able to get access to managers through ETFs, like Kathy Wood, great manager. She's run that portfolio really well, run it up, and there's $50 billion worth of money invested with her. So a lot of people have participated alongside her. I think that there are lots of value guys who are probably starting ETFs now, that I think that there's one of them will have or a few of them will have a really good run over the next few decades, and the average investor will be able to participate alongside them. So I think that even though that's a technical change, the practical implications of that are huge for the average investor. As for the worst thing, it might be that there's all of this new competition coming in value ETFs from these new managers some of whom are going to do really well. And I like it as more of an exclusive club, selfishly, but no, I'm joking. That I think it's a great vehicle, and so I think it's all good.
Wes,
anything really, really bad happening to ETF investors over the
yeah. So I mean,
the
we're
past
up
few
on
years?
the forefront of this because I literally do 3 or 4 calls a day with people that want to launch ETFs now, because we're a manufacturing business where we help people get to market. So, and to Toby's point, there are some amazing talents coming to market where normal in the old days that have been a hedge fund, tax inefficient, high fees, and now you're going to be able to access these great talents at low fees, global access, tax efficiently, right? So it's amazing. ETF's great for investors, but to our prior conversation, what is so terrible about the ETF? Well, it's the same thing that's terrible about access is now you can trade it every day. You can move in and out of it every day. That's the issue. It's a behavioral problem. So even though the investment opportunities and the cost to access them have came dramatically down, it doesn't matter because people are going to screw it up by day trading the value managers now. I could just, I start to feel like Jack Bogle here. It's like that guy was super smart, man. Like, people screw things up because they're people. Even you could, bring the horse to water. They don't drink it. They just avoid your advice and, go eat cyanide, I guess.
Maybe you guys could cite the CGM's mutual funds results from 2000 to 2010 as an indicator of how bad that behavioral friction is. Ken Hebner's fund.
That's Ken Hebner. Yeah.
Yeah.
That's in quantitative value, isn't it? It was like the fund outperformed by.
That's why I'm teeing it up
18%.
for you guys here.
The fund was 18% a year, and the individual investor in it was 11% a year negative, because the fund was volatile and had this gigantic run up at the end, and so most people just traded it the wrong way. When it was up, they sold it. When it was the other way around. When it was up, they bought it. When it was down, they sold it, and turned an 18% compound into 11% negative.
Ben Johnson, I think he's one at Morningstar, has a cool study where they look at like over a 10-year period, like the best performing funds. And then they look at how like the Morningstar rankings and all that stuff go. And literally like the top performing funds, that usually it's the case that only 2 out of 3 years they outperform the market. So they usually in a 10-year window, they have 7 years of like egg on their face. But that's how it normally works. Like in order to outperform, you have to do crazy, weird stuff and have horizon. If you don't, well, get back in line with every other idiot. And so there's just a trade-off. If you want to win and be the best over the long haul, you got to do weird stuff, and it's got to be unique, and you got to be ready for, like the stats say, 7 out of 10 years looking like an idiot. And that's not fun for a lot of people. It's just a fact of the marketplace.
All right, Jens. So this has been a great conversation as always. Whenever I have a chance to hang out with you. Before I let you go, I'd like to give all of you an opportunity to let the audience know where they can learn more about you. Wes?
Sure. Just alphaarchitect.com. And if you want to launch an ETF, etfarchitect.com. Pretty simple.
All right, Jake?
Sure. My investment shop is farnam-street.com. Got a book, Rebel Allocator, on Amazon. Do a kind of fun podcast with Toby every week with our Value After Hours. And that's, just say hi on Twitter at FarnamJake.1 or FarnamJake1. And not too hard to find. Although I should probably try to be harder to find something.
JT undersells his book. Charlie Munger read Jake's book and liked it so much he gave him a call. He called him up and had a chat to him, and he's trying to help him make it into a movie. So if you haven't read that book, you should go and read that. It's a good book. And you should come to acquirersmultiple.com, which is my website where the podcast that I do with Jake is hosted. And you can hear the man who spoke to Charlie Munger and hear what he has to say. I run 2 funds. One is called the Acquirers Fund, ZIG. That's mid-cap and large-cap US equities, US value, deep value style, and deep, which is small and micro. Same strategy, just in a different universe with a little bit more diversification. And I'm on Twitter at Greenbacked, GRENBACKD. I think that's it. Thanks, Stig.
All right. Fantastic. All right. As always, make sure to follow us. If you're watching this on YouTube, make sure to subscribe. And Jens, I guess I'll see you next quarter.
Sounds good.
Thanks, Stig.
See you, fellas.
See you guys.
See ya. Look forward to it. Bye.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.